Hey, what's up, good people? How you doing today? Hey, welcome back to Stock Up with Larry Jones. Today, we have answers to some questions that many of you will be asking throughout the month of December. And that is, what is tax loss harvesting? How should I prepare myself for the government? How much do I owe? Blah, 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 all of that. So I brought in a specialist today. Everybody say what's up to my man, Carter Cofield. Go ahead and introduce yourself.
How you doing, Larry? Man, good to see you again. First of
Good to
all,
see
the
you
last
again. Yes,
episode was
sir.
great, so I'm happy to be back again. Again, guys, my name is Carter Cofield. I'm a CPA and tax strategist here to give you all the game to help you all live tax free.
That's cool. That's cool. That's cool. Hey, so let's just dive right into it. What is tax loss harvesting?
Yeah, so I know the people hear the term tax loss harvesting a lot, but not a lot of people
Say it
know
slowly. Tax loss
tax
harvesting.
loss harvesting. It pretty much sounds like we know what the name is. It's a way to
Yep.
harvest your losses. So the way I
Yep.
teach my students is that it's a tax strategy to turn temporary stock losses into actual tax deductions, right? So an easy scenario is that we know this year the market's down. For most people, the market's down. Their portfolio is going to be in the red, but we don't actually get to recognize any losses or gains until we actually sell the stock, right? So right now, let's say somebody bought Apple, about $10,000 worth of Apple at the beginning of the year, and now it's sitting at 7,000, right? In order to harvest those losses and actually get a tax deduction, they need to sell though that security and sell that portfolio at a loss. Now, was nice about tax loss harvesting is when you sell, you're able to take the loss as the deduction against capital gains income, meaning other stock gains or real estate gains, or you can even take a portion of the losses against your ordinary income.
Okay. Is there a cap on the losses?
Yeah, so there's no cap if you're subtracting the capital losses from
Hmm.
capital gains. There's absolutely no cap. So if you have $10,000 in losses, I mean in gains, and you have $8,000 in losses, you can take all those 8,000. However, if you're taking the stock losses against your ordinary income, you're capped at $3,000, right? Because of $3,000 ordinary income loss. But here's the thing, Larry, because a lot of us, just because our stocks are down, doesn't mean that we actually want to be out of the position,
Right.
right? So when we sell, there's something called a wash sale rule. That means once you sell the security, you have to wait 30 days to buy it back. So you can sell your crypto at December, 30th, buy it back the next day. You can sell it at noon, buy it back at 3 o'clock, right? There's no wash sale rule with crypto, but with
Mhm.
stocks, there's a wash sale rule that states you have to wait 30 days before you rebuy that same security. And I know you, Larry, I know the amazing people that you teach, they don't want to be at the market for 30 days. So how do we
Right.
overcome that, Rua? How do we get around it? Well, you can buy a like kind security that holds the stock that you just sold. So you can sell Apple, but buy something like QQQ that
Yep.
holds Apple. That way you're not out of the market.
So you've seen a W sometimes if you sold at a loss and then you tried to buy back in. Sometimes you see that W
Mhm.
beside your equity. That's what that is. Watch sale. So since we're talking about that, can you give the people a breakdown on tax rates as if you keep a equity or a stock under 30 days, over 30 days, and under a year?
Got you. So there's something called short-term losses and long-term losses, right? Or short-term rates and long-term rates. So if you buy a security and you hold it less than a year, whether it's 30 days, whether it's 20 days, if you hold it less than the year, you're going to pay ordinary income tax rates on the gains from that sale. So ordinary income rates could be, on average is 24%. So if you make $1,000, you got to pay 240 in taxes. That's a lot of money, and I don't want people paying that. So what I encourage my students and everyone else to do, to hold your securities for at least a year, because once you hold the securities for 366 days, you now go from paying ordinary income tax rates to
Mhm.
capital gains tax rates. And just to give you some clarity on the difference, on average, 24% is ordinary income tax rates, but capital gains rates at that same income level would be around 15 or 10%. So now you're saving almost half just by holding the portfolio or the stock just a little bit longer.
That's a great question. So if you hold it for more than a year, now we do know that we have day traders, which pay the highest tax rate. We got swing traders, and then we got investors. Investors pay a lower rate because they're going to hold that stock longer than a year. All right, we're building generational wealth right here. Right? Hey, we're moving really good. Okay.
Yeah.
So let's talk about what a Roth IRA is. Talk about the age and how much you can invest into one, right? And then talk about the income cap of it. So take your time.
No, because we have to take our time on this one, because Roth IRAs are one of the most powerful investment vehicles that are allowed to the general public. So what does a Roth IRA even mean? So it's simple. It means that when you put the money into the individual retirement account, which is what IRA stands for, you're able to, you don't get a tax deduction for the money that you put in, but when the money grows, it grows tax-free forever. There's a rarity that you ever hear tax-free and forever in the same sentence, Larry. So Roth IRAs allow you to have that long-term tax-free money. So that is the basic of what a Roth IRA is. And just to show you how powerful a Roth IRA is, Peter Thiel, one of the most famous investors and former owner of PayPal.
Tell him about this. Tell him about it.
Man, look, this man was a genius, okay? He turned a $6,000 Roth IRA into over $5 billion.
Tax free.
Not just regular $5 billion, $5 billion tax free. That means the government missed out on taxing $5 billion. And that just shows you the power of a Roth IRA. So I tell people all the time, the first dollar you make every year, the name on that money should be Roth IRA. Like, don't spend money. Don't go to the club. Your first $6,000 already has a name on it, and that name is Roth IRA. Okay, guys? So please trust us on this and open a Roth IRA if you don't already have one. But you need to have one. So that's what a Roth IRA is. Now, there are income limits on a Roth IRA because it's such a powerful vehicle. The government didn't want rich people taking advantage of it. So if you're single and you're making over $144,000 in AGI, you can't contribute to a Roth IRA. Or if you're married and make over $214,000, you cannot contribute to a Roth IRA because they don't want wealthy people taking advantage of the system. Now, Larry, is it okay if I teach people how to get around that?
Come on, talk about it, Backdoor.
Because if you want to pay less tax, simply change the facts, right? And this is why the tax code is so powerful, because you need to understand how to get around it. So as Larry mentioned, because he's a very, very wise gentleman, there's something called a backdoor Roth IRA. So what does that mean for you? So the government put income limits on contributing to a Roth IRA, but they didn't put income limits on converting into a Roth IRA. So the way you do a backdoor Roth IRA is you open up a traditional IRA or a non-deductible IRA. You simply fund it with $6,000. Then you wait the next day. You call up your broker, TD Ameritrade, Fidelity, whoever. You call them and say, hey, I want to convert my non-deductible IRA that I set up yesterday. I want to convert that to a Roth IRA. And I don't care if you make $5 million a year. There is no income limits on converting a non-deductible IRA into a Roth IRA. So that is a strategy. Now anybody in the world, rich or poor, can now take advantage of this powerful Roth IRA strategy.
And that's why if you watch a few videos ago, I was challenging people to do a side hustle and to create $125 a week. Why? Because that's $5,000. I'm sorry.
$500 a month.
Exactly. $500 a month. And what does that equal in a year? Your cap on a Roth IRA. That's what. Not to mention, when they start the side business, they'll now be able to take advantage of tax deductions like writing off their cell phone bill, writing off their internet, writing off their meals. So, Larry, not only are you helping them make an extra $500 a month to put away in a Roth IRA, you're actually saving them anywhere between $5,000 and $15,000 in taxes once they start taking advantage
of these tax deductions. You really care about your people, man.
I do, and actually, and actually, and I learned this from you by converting to an S corp. You're saving about $11,000 per $100,000. Okay, so let's
Easy.
talk about this. Let's talk about the higher incomers because I actually got a dual question. One is it ever a good idea? Let's say you have investors out there and they're making a lot of money and they says, hey, I'm going to be a day trader, right? I'm tapping out of the job. I'm making enough money doing this. Should they continue doing it themselves, or could they consider investing under a corporation, meaning forming their own corporation?
Yeah, so this is a great question. And I'll just start by saying the IRS does not like day traders.
Mhm.
So they make it really hard for day traders to take advantage of tax deduction. So if you
Let's say
decide,
even if you're swing trading.
yeah, if you're swing trading,
Mhm.
or in and out the market with with pretty high frequency, you have to get what's called TTS, which is trader tax status, and you also have to get MTM, which is mark to market status. Now,
Yes.
once you get both of those, the IRS sees your trading as a business, and you're now
Mhm.
entitled to the same tax deductions as ordinary business owners. So, if you want
Mm.
to be a trader, absolutely, but you want to get that TTS status and get that mark to market status, because now you can start getting a tax deduction for your trading subscriptions, for your computer setup, for your home office, for all these things. But until you get that trader tax status, they don't see you as a business and you can't write off those expenses. So I think if you're going to do it, just make sure you do it properly and get those status updates so that you can take advantage of tax deductions.
Let's bounce back to a Roth IRA.
Let's
Um,
go. I love it.
how long do you have to hold your money in a Roth IRA, and how
Mhm.
old do you have to be before you can start drawing from it tax free?
So here's the amazing part of our Roth IRAs that most people don't know. It's crazy that it's just most people don't know this. So with a Roth IRA, your contributions you can take out at any time. So let's say, Larry, let's say you put $6,000 in there for 10 years. That's
Hmm.
$60,000 in contributions. That
Hmm.
money's already been taxed. So you can take up to $60,000 of your out of your Roth IRA at any point, and you don't pay taxes or penalties on that because that's the money that you contributed, right? Now,
Ah.
so think about it. Your Roth IRA could actually become your emergency fund
Hmm.
because you could take up to all your contributions out tax-free, penalty-free at any point. So a Roth IRA is not an account that you can never touch. You just can't touch your earnings, your
Gains.
gains until you're 60 and a half. So
Okay.
it can act that as an emergency fund and as
Hmm.
an investment account, right?
Now, didn't they
So
lower that to 59 and a half?
I'm sorry.
Yeah.
Sorry, 50, absolutely 59 and a half
Yeah.
for you to be able to take the money out of, to take the
Hmm.
earnings out of your Roth IRA without any penalty. But don't
Right.
forget, those contributions have already been taxed. So you can use that money in the interim if you so desire.
And so if you're over 50, you get to contribute $6,000. But if
Well,
you're under, go ahead.
yeah, so if you're over 60, you actually get a catch-up contribution of an extra $1,000, if I'm not mistaken. So I think if you're
Yes.
over 50, you get the catch-up contribution. So now instead of 6,000, you can put 7,000 into your Roth IRA for those years to catch up. So it's just a powerful vehicle, and you can actually use some of the money out of your Roth IRA for special circumstances like purchasing your first home. So
Yeah.
there are certain requirements that allow you to take the earnings from your Roth IRA and still not have a penalty on it.
Wow. Hey, I got a few more questions. One
Hey, I'm here
is, and
all
this
day.
is my man. One is a little complicated, and if you got to get back with me, I understand. So let's say you started a Roth IRA, right? And you've had it for years, right? And you've been contributing. And when you started, you were making under 100,000. Now
Mhm,
you're making 200,000. What
mhm.
happens to that Roth? Do you have to cancel the Roth that you have because your income level has peaked out? What do those people do? Because I get that question a lot.
Great question. Phenomenal question. So once you go over the income threshold,
Hmm.
you can still your nothing happens to your Roth IRA. It still can sit there, it still can grow. You just can no longer contribute to it. Right. So you don't
Yeah.
have to close out your account or transfer or convert it. You can sit, watch it grow, and smile as those tax-free earnings grow. But the only unfortunate part is you won't be able to contribute to it unless, of course, you do the backdoor Roth IRA strategy, and then
Yes.
you're all good to go.
So with the back door, you can continue. You can annually contribute.
Yep. So you would just open up a non-deductible IRA and then have
Mm-hmm.
them convert and transfer that money to the
Mm-hmm.
IRA, the Roth that you already have open. That's what I currently do at this point.
There you go. And I can tell you, good people, that Fidelity will literally walk you through it. You can just pick up the phone and call them, and they will literally walk you through it over the phone. All right.
Shout out to Fidelity.
That's it. Shout out to the legacy brokers. Hey, I'm going to end this, and we gotta have you back because this is his fire information. All right, I'm gonna just hit you with two more. Number one,
Okay.
let's say you got a corporation, right? A DBA or a corporation, an LLC, and you had a good year, and you're looking for some major write-offs, right? A lot of people don't know about the 6,000-pound vehicle. Could you talk about that really quick?
Yeah, I'm actually closing on another vehicle today in like an hour because
Bro, I'm ready to go shopping. Where we going? No, I'm waiting. I'm waiting. Go ahead.
yeah, no. So well, most people don't know that this year is actually the last year that you can get a 100% tax deduction for purchasing a business vehicle that weighs over 6,000 pounds.
So
So
this is the last year?
this is the last year you get 100%. Next year it goes down
Man,
to 80%. The
you
year
just
after it goes
changed
down to
my
60%.
whole game plan.
Hey,
Go
I'm
ahead.
telling you, I'm shopping, right? I'm closing on a car, right? Like after this call, because it's the last year you can get 100%. So if your car, think about this.
Hey, man, what color is your Range Rover? No, I'm just joking. Go ahead.
Uh, I'm actually looking at something that's a little bit more pricey than that. It was a good year.
Ah,
But let's say you have $100,000 in net income in your business. You're going to pay
mm-hmm.
about $30,000 to $35,000 in taxes on that money. That's a $35,000 tax bill. Or
Wow.
you can go shopping and get a Range Rover that costs $100,000. Let's say you put like $5,000 down, but the
Right.
fact that the vehicle is worth $100,000 and it weighs over 6,000 pounds, you will get $100,000 tax deduction this year,
Oh,
even if you bought the
man.
vehicle in December. So now
Right.
by buying the vehicle,
Even if you finance it and just put $5,000 down, you still get the write off.
you still get the 100% write-off. So now you just
Yeah.
put $5,000 down, and you just your tax bill went from 35,000 down
Yes.
to zero because that Range Rover wiped out all your income. And it's even better about this, Larry, is
Yeah.
that if you were to go try to buy a home,
Mm-hmm.
right? People are like, well, now my income is at zero. How can I buy a home? Well, the loan officer actually adds back depreciation to your income. So now you can still get the home next year, and it doesn't matter. It doesn't change any of your obligations or your rights to get a loan. That's why depreciation in the 179 deduction is so
Mm-hmm.
powerful.
Man, I didn't know this was the last year. I'm gonna be honest with you. Now I gotta go car shopping. I didn't want to
You
get a
got
car, but I gotta go car shopping. I'm not
you
missing
got
out.
you got a little over 30 days, brother. So
Hey, I already got
that's
my eye
plenty
on
of
something
time.
that I was gonna do about a year and a half down, but I'm gonna have to pull the trigger now. Hey, in closing, this has been really, really great, Carter. What is a gem that you just want to drop on the good people? Tax advantages that a lot of people just kind of overlook.
So I'm big on generational wealth and tax saving at the same time. So one thing that most people don't take advantage of is what I call the board of advisor strategy. And I'll try to keep this brief.
Mm-hmm.
If you hire your family and friends, or let's say you can hire your family on the board of advisors of your company. LLCs and S corps are allowed to have board of advisors. So you can pick your wife, your kids, your cousins. You can
Mm,
have 3 to 5 people on your board of advisors.
okay.
And with that, you now get to have quarterly board of advisor meetings anywhere in the world with these people. So now you can turn
Vacation
exactly. Now you
slash
can turn
business meeting.
exactly. Now you can turn Thanksgiving into one of your board meetings, and you can have a destination Thanksgiving. You can turn Christmas into one of your board of advisor meetings. You can turn a trip out the country with you and your family.
Mm,
Now you're teaching your kids how to be business owners. You're traveling and spending time with your family, and
mm-hmm.
you're getting tax deductions and building generational wealth at the same time.
Does that have an age cap on the family members?
No, there's no
So,
age cap. I mean, if they're like under 5 years old, it's going to be hard to prove that your 5-year-old can be on your board of advisors.
Exactly.
So I would say anywhere from 7 and up, but there's no required age cap. But like you could just talk business, and now you're teaching your
So,
kids business strategies.
so you're telling me, and you're telling the good people that they could plan their trip to Disney World, and they could, to be honest, sit down and have a business meeting a day or a few hours, and then enjoy the rest of the vacation, and that is a write-off.
We have hundreds of clients that do it. Many of my students do it. All you have to do is make sure you document the meetings, you document your board of advisors, you
Yes,
take meeting minutes. But yeah, you can spend 2 hours in the morning having your board of advisor meeting and spend the rest of the day at Disney World. And now you made money and got a tax deduction, spend time with your family at the same time. Wealthy people do this all the time.
they do.
Why don't we do it?
They do. Just why you think it was the weight limit on the car was 6,000 pounds. They know the average car is under 6,000 pounds. And yeah, we know it's for business vehicles, box trucks. And
Mhm.
that's why, the most of the people that's listening here, they can't afford a $50 million jet, you know,
Mhm.
but they get write-offs for that. All right. And we don't, because we're not in that tax bracket. Man, this has been outstanding. I almost said out freaking standing. And so I absolutely love helping people. Listen, good people, if you have heard one thing that has helped you, make sure you hit the like button, subscribe, of course. Check out the 2 links below. Carter, where can they find you?
They can find me on all social media platforms, Cofield_advisor. I'll give you my Instagram handle in the show notes below. Also, my YouTube channel, the Melanin Money Show. I have a playlist where I give I do tax-free Tuesdays every Tuesday on my YouTube channel. So I give gems, major gems every single Tuesday. So I'll link to my YouTube channel as well.
Hey, it's been great. Carter Cofield and I myself, we met on the speaking trail. I speak all over the world, and so does he. And we met up, in the speaking game. And I sat and listened to him, and he dropped a ton of knowledge. Hey, as always, Cofield, it is my honor and pleasure to have you on as a guest. And one day we're going to do this live so we can be a further help to the good people. Make sure you click the links below. Check out Carter Cofield on all his social media platforms, and we'll talk to you later. Live, love, laugh, and learn.
Thank you, y'all.